Hey everyone, I'm Seth David from the world-famous Nerd Enterprises Incorporated, and I'm partnering with QuickBooks to bring you this video series on topics that help you run and grow your business. Today we're going to tell you everything you need to know about marginal cost and marginal revenue. Before I continue, don't forget to subscribe to our YouTube channel and bang that like button if you like what you see. And if you like to read, check the description below for the link to the article. As your business expands, understanding production cost is key to finding the optimal profit to sustain sales and revenue increases. Marginal cost is the cost it takes to produce one additional unit of a product. They're made up of two kinds. There's fixed costs and variable costs. Fixed rate costs stay the same no matter what. They're known for a prescribed period of time. Examples of this would include rent, fixed rate mortgages, insurance, and property tax. Variable costs change with production volume and can either go up or down. For example, we may lower prices on bulk purchases, but then labor costs may go up as production increases. Examples of variable costs are labor, raw materials, equipment repairs, and commissions. Even though marginal cost technically measures the cost to produce one additional unit, manufacturers often look at this in batches to determine the merits of continuing production. To calculate marginal cost, you divide the change in cost by the change in quantity, or the number of additional units. While marginal costs reflect the cost of producing one additional unit, marginal revenue is the revenue produced by the sale of one additional unit. When marginal costs are equal to or exceed marginal revenue, the business is not making a profit. This is when it's time to scale back production, and this is why marginal revenue is such an important metric. You see what you learn here for fun and for free? To determine the best pricing strategy for your business, you'll need to calculate your marginal revenue. Marginal revenue is calculated by taking the change in revenue divided by the change in quantity, or the additional number of units. Knowing your marginal costs and how it relates to your marginal revenue is critical for pricing and production planning. You might need to experiment a bit until you find the optimal profit margin so you can sustain sales and revenue increases. QuickBooks Online Advanced makes it simple to see which projects make money and which ones break the bank. Sign up and track your inventory easily with real-time updates and reports, and unlock important insights like job costing, profit margins, and more. Whoa! That was a lot of valuable tips and information. Do me a favor, if you like what you learned here, give us a like, bang that subscribe button so you can get more updates from us. We would really appreciate it. And I'll see you in the next video.